Hello everyone, welcome back. I am coming to you today because the silver market is doing something it hasn't done in decades. It looks calm for about 5 minutes, and then, out of nowhere, it tries to rip your face off. If you've been watching the price action lately, you know exactly the roller coaster I'm talking about. Silver pushes higher, the mainstream headlines start screaming, "Bubble!" and then some massive invisible hand slams the price down like they're trying to pin it to the floor. But here is the uncomfortable question that no one on Wall Street wants to answer. If this is all just speculation and hype, then why are the physical shelves getting emptier by the day while the paper price is still arguing with itself? In this video, I'm going to pull back the curtain on what is actually happening beneath the surface. We are going to explore why the physical shortage is getting louder, why the West and the East are no longer telling the same story, and why the most important clue in this market is not a candlestick chart. It is the metal quietly disappearing from the vaults. We'll talk about the smackdowns, what they're trying to achieve, and why this market keeps snapping back like a compressed spring. But before we go deep into the mechanics, I need to check in with you. My YouTube stats show that a huge chunk of you watch these deep dives every week, but haven't hit that subscribe button yet. If you find value in this research, hit subscribe and drop OG John AG in the comments. I need to know you've got my back as we navigate this chaos. Also, make sure to check the description when we're done. I've left some premium resources there, including the WhatsApp channel and membership links for those of you who are serious about staying ahead of the herd. Now let's get into the real fight. Imagine a massive tug of war. On one side you have the paper market. This is a digital ecosystem of futures contracts, options, ETFs, and leverage. It's a world of claims and promises. On the other side, you have the physical market. This is real metal, heavy bars, minted coins, actual delivery, and real-world constraints. Most days, the paper market pretends it's the only game in town. The mainstream narrative is built on this. Price is truth. RSI is overbought. This must be a top. But the physical side doesn't care about your indicators. It only cares about one thing. Can you actually get the metal when you need it? And right now, the answer is becoming a resounding no. We are seeing vault inventories drop at the exact same time that price and excitement are climbing. Think about how weird that is. In a normal bubble, people rush into paper assets and vaults stay stable. But here, the vaults are being drained. Someone, somewhere, is redeeming digital shares for physical bars and taking them home. They aren't interested in a ticker symbol anymore. They want the weight in their hands. And when the big players start opening the vault doors, you know the game has changed. Now, let's zoom out and look at the global stage, because the East and the West are currently living in two different realities. If you look at the Shanghai Gold Exchange versus the London or New York markets, they are not agreeing on what silver is worth. For weeks now, we've seen the Shanghai price trading at a massive premium over the Western spot price. I'm not talking about a few pennies here. We've seen gaps so large that any arbitrage desk should be licking its chops. In a normal functioning market, traders would simply buy the cheap silver in the West, ship it to the East, sell it for a profit, and the gap would close. Simple, right? But the gap isn't closing. It's persisting. And that screams to me that the pathway is clogged. Visual of a map showing silver flowing from west to east with a blocked sign. Why can't the metal flow? It's not just about shipping. It's about conversion. Not all silver is created equal. An exchange spec 1,000-ounce bar is not the same thing as jewelry, scrap, or retail coins. To settle institutional trades, you need specific formats. And my industry contacts are telling me that major refineries are running 24/7, multiple shifts, 7 days a week, and they still can't keep up. Think about the implications. Even if there is silver somewhere in the world, if it isn't in a deliverable bar format right now, it might as well not exist for the market's immediate needs. Somewhere is a story. Deliverable is reality. This is why you re-seeing bullion dealers facing longer lead times and certain products going out of stock. For decades, the silver market has survived on a system of confidence. Confidence that if you have a paper claim, you can get your metal. But confidence is not metal. Confidence doesn't conduct electricity in a solar panel, and it doesn't settle a massive short position. Table showing paper claims versus physical ounces ratio. The banks are hedged argument doesn't reassure me anymore. A hedge is only as good as your ability to enforce it. If your hedge depends on a venue where delivery is being delayed, rationed, or functionally discouraged, then your hedge is just a hope, and hope is a terrible strategy when you're facing a physical shortage. We are watching a slow migration away from paper promises and toward physical possession. The leverage ratio is becoming the story. The entire financial structure is built on the assumption that only a tiny fraction of people will ever ask for the bars. What happens when that fraction doubles or triples? That is the cliffhanger that mainstream finance is too terrified to talk about. If the physical reality is so tight, then why do we keep seeing these sudden, violent price drops? You know the ones I am talking about, those 2 a.m. or 8 a.m. hits where the chart looks like it just fell off a skyscraper. If you've watched silver long enough, you've seen this movie before, and it's designed to do one thing, scare you out of your position. But here's the mechanics of the smackdown. Leverage is incredibly fragile. When the paper price starts creeping up and sentiment improves, it puts massive pressure on the large trading desks and market makers who are net short. Visual: a graphic showing short positions being squeezed by a rising price. When I say net short, I mean these entities have sold more exposure than they actually own. We are talking about tens of thousands of contracts. If you convert that into ounces, you're looking at hundreds of millions of ounces of liability. That is a massive chunk of global annual mine supply sitting as an IOU on a balance sheet. So, what do they do when the heat gets too high? They lean on the futures market. They dump massive amounts of paper silver into a narrow trading window, usually when liquidity is low. This triggers stop losses, scares the weak hands, and forces the price back into a safe zone that doesn't blow up their books. But here is the catch they can T-fix. Pushing paper around doesn't create more physical metal. They can manipulate the perception of value, but they can't manipulate the availability of the bars. This is why you see the snapback effect. The price gets slammed, and within hours it starts crawling back up like nothing happened. Why? Because the underlying demand from industries, solar, electronics, medical, doesn't care about a 10-minute paper dump. They need the metal to keep their factories running. Image: refinery worker versus a Wall Street trader. This is a game of borrowing time. The system depends on you staying in paper. It depends on you taking a cash settlement instead of asking for delivery. It depends on you rolling your contracts over. But the trend we are watching is a slow, steady migration toward physical possession. When you hear people say, the banks are in control, remember that control is not infinite. You can juggle 10 balls, maybe 20, but eventually, the physics of the market take over. If current prices can't bring enough metal into the deliverable format, the price must rise. That isn't an opinion, it's the law of market clearing. Everything else you see on the news is just theater. So where does this leave us? We have a market where the paper price is trying to hide a physical reality that is becoming impossible to ignore. But I want to give you something practical to watch over the next few weeks, a scoreboard for the silver squeeze. First, watch the Volt data. If reported Volt stocks in Western ETFs keep sliding while the price is grinding up, pay attention. That is the smoking gun. It means the authorized participants are siphoning the supply chain. Second, watch the spreads. If Asian premiums stay elevated, it means the East is still hungry, and they are willing to pay more than the West for real metal. This will eventually force the Western price to catch up or lose all its metal. And third, watch the refinery lead times. When you call a dealer and they tell you back-ordered or delayed, don't look at it as a nuisance. Look at it as a signal. Retail often feels the smoke first before the rest of the building catches fire. I want to speak directly to the stackers and investors watching this. This market can mess with your head. It will offer you euphoria one day and fear the next. But remember the difference between speculative demand and survival demand. Speculators trade the dips because they want a quick buck. Survival buyers, factories, solar companies, and smart investors buy because they need to protect their future. Survival demand doesn't vanish just because an RSI indicator flashes red. My advice? Don't let a 10-minute price dump rewrite your long-term understanding of physics. If current prices can't solve the shortage, the only lasting solution is a higher price. Everything else is just noise designed to shake you out. Before I go, I want to hear from you. Have you tried buying physical silver recently? What kind of premiums or delays are you seeing in your part of the world? Drop your experience in the comments. And if you've had a win, big or small, share it. Your story might be the motivation someone else needs to stop procrastinating and take action. Don't forget to check the description for the premium WhatsApp channel and membership links. We are building a community of serious investors who look past the headlines. Stay calm, stay sharp, and I'll see you in the next video. Let's see how the market reacts to the next pressure point.